the move this month in emerging markets? Do you feel like it's panic or is it capitulation?
I don't think it's capitulation at all. We put a note out a couple of weeks ago, a little bit more than that ago, where we said that we thought a lot of evidence that sentiment, of course, has deteriorated badly in EM, but I think we're far from capitulation levels. I think what you've seen in August is two phases of selling, frankly. You had a very, very weak couple of weeks at the beginning of the month, which was mainly driven by the crisis in Turkey, which of course had spillover effects on the euro being weaker, dollar being stronger, which tends to hurt all emerging markets. Then we had a bit of a pause with a nice rebound as the dollar softened, and now we're back into a crisis environment, if you like. I think we shouldn't overdo the crisis environment. It's very specific, I think, what's going on here, and it's making the asset class look obviously rather weak at the moment again.
Well, let's break down some of the brats, and I want to start first off with Turkey to kind of look at what has happened to that currency so far. Record low after record low. Central bank deputy governor said to resign, not going to participate in traditional monetary policy like in Argentina, but kind of on the sidelines. But that's not working either. Is there any solution on the monetary front for Turkey?
There's no doubt the solution in Turkey on the monetary front is a sharp increase in interest rates, combined with much greater confidence than there is today about the, should we say, the prudence generally of economic policy. Fiscal policy is too loose, monetary policy is too loose. Obviously, the situation in August was exacerbated by the political spat that broke out between the US and Turkey. And of course, you've had a strong dollar, which, as I've said many times on your program, is always a problem for EM. And these things have made what were poor fundamentals in Turkey really stand out anyway, with a large current account deficit financed by short-term capital flows. There has not been an adequate response, in our view, from the Turkish central bank. So the most important thing you could do in Turkey to really improve matters there and start to bring some money back would be a sharp increase in interest rates. And frankly, we're still waiting for that. Right.
But when you have Argentina that did it, it's not helping them either. And I have this great chart if you come inside the Bloomberg. So the top panel that you're looking at, the blue line is rate hikes. And you can see soaring, right? We're at 600 basis points now. Yet, when you look at dollar peso, it's continuing to rise. When you look at the bottom panel, which is Turkey, they're not doing anything with rates, and the lira is still falling. So you can't win on either fronts.
Well, obviously every country is different, and Argentina is facing a uniquely complicated situation, which we think, if you take it back over a period of several months, has been driven by, I think, a confusion about the direction of economic policy, has been driven by apparent compromise on the independence of the central bank. They have not been able to get inflation under control. The growth of the economy is very, very weak indeed. And I think it's all been made more complicated by not a very good messaging process with respect to an IMF loan that they've been seeking, and now they want to front load that loan, and the IMF hasn't agreed to that yet. So you've got to have talks about that. So I think it is arguably a more complicated situation in Argentina, which is trying to recover after many, many years of very, very poor economic policy. So I think all we're saying here, Alex, to be fair, is these are maybe the two weakest we're talking about, although Argentina actually is not part of the MSCI Emerging Market Index at this point, equity index at this point, but every country is different. Meanwhile, in August, a number of other countries, most of Asia, except for China, and even parts of emerging Europe, have actually been rising. So it's been very idiosyncratic in our view.
100% accurate, especially if you take a look at EMFX getting hammered, but actual EM equity is holding up, which speaks to that China divergence story. But wrapping it up, though, with Brazil, talking about idiosyncratic risks, how much more selling, how much more downside do you think is left in Brazilian assets?
Our view is that the dollar's going lower by the end of the year, not by much, to the 120 level against the euro. That means, in our view, that there will be a rally in the real between now and the end of the year, about 415 this morning to about 370. Now, the key issue in Brazil short term is, of course, the upcoming election, round 1 early October, round 2 second half October. And we think there's going to be quite a lot of turbulence during that period. But once that period is over, much like happened in 2002 when President Lula was was elected for the first time, you will probably see policy stabilize, interest rates be raised, and the currency will probably rally. Brazil's problem this year, Alix, has been two things. The election is not going as well perceived for the markets as expected. The markets wanted to see more of a right-wing pro-reform candidate come through in the polls. That has not happened yet. And secondly, the economy's been shockingly weak compared to expectations at the start of the year. Those have compounded the issue in a year where the dollar's been obviously very strong. We think there's a bit more turbulence to go in Brazil as you head towards the election, but you probably should get a rally in the Brazilian currency before the year end. And we wouldn't be selling Brazilian equities at this point. We think they've sold off enough. It's just we're not yet prepared to say, look, it's time to buy at this stage.
We have a question from a viewer on Bloomberg, Geoff, and they're asking about Turkey, saying with over $150 billion in U.S. debt coming due in the next 12 months, $80 billion in the next 6 months. Some say that large-scale defaults in Turkey won't impact EM in Asia because of the difference in that macro stability. But if Turkey winds up blowing up sort of the dollar and the euro market and strengthens the dollar, that's the knock-on effect. That's a second-round effect to Asia. What do you think of that pass-through?
I had to relearn some of my basic rules in the last couple of weeks last month because I didn't think Turkey could blow up the emerging markets, but it sort of did in the first half of the month, and the transmission mechanism then was through the concerns about European banks, which have got a lot of exposure to Turkey. So I think if you were to get a full-scale meltdown in Turkey over and above what you're getting now, which we do not believe will happen, by the way, and we don't think there's going to be major corporate debt defaults in Turkey, but if that were to be the case, that will impact emerging markets generally because it will probably be dollar positive, put the euro under pressure, which would put all EM under a certain amount of downward pressure like we had in the first 2 weeks of the year. We think that is too gloomy a scenario now, given how low, Turkish equities are down 55% this year in dollars. The currency's down well over 20%. We're not saying we'd buy it here, but I think to get too gloomy here with widespread defaults is probably not correct.